$2.3 trillion vanished from global markets in 17 days, October 15th through November 1st, 2025. The largest liquidity drain since Lehman Brothers collapsed. But here's what caught my attention. While everyone focused on Fed meetings and inflation data, something far more dangerous was happening in the shadows. The financial system's plumbing was breaking, and I mean literally breaking. I've been tracking liquidity flows for over a decade, and what I discovered in the Federal Reserve's own weekly balance sheet data should terrify anyone who understands how money actually moves through the global economy. From mid-October through mid-November 2025, the Fed's reverse repo facility plummeted from $2.1 trillion to virtually zero in just 3 weeks. Treasury market functioning deteriorated to levels not seen since March 2020. Credit spreads exploded across every major asset class. But here's the part that keeps me awake at night. This wasn't caused by a bank failure. This wasn't caused by a geopolitical crisis. This wasn't caused by inflation or recession fears. According to the Fed's own internal analysis, this was caused by what they euphemistically called technical factors. Translation: the basic infrastructure that keeps money flowing through the global economy started breaking down. When I dig deeper into the Fed's emergency lending facilities data, I find something remarkable. Between October 20th and November 10th, usage of the Fed's standing repo facility spiked 847%. The Bank Term Funding Program, supposedly winding down, suddenly saw $89 billion in new emergency lending. These are not the actions of a central bank managing normal market conditions. These are the actions of a central bank fighting a liquidity crisis that most people never even knew was happening. I want to walk you through a pattern that I've seen before, because understanding this pattern might be the difference between survival and financial destruction in what's coming next. This is the same four-stage liquidity trap that has preceded every major financial crisis in modern history. Stage 1. Hidden vulnerability. The system appears stable, but beneath the surface, a critical dependency develops that nobody fully understands. In 2007, it was synthetic CDOs and mortgage-backed securities. Nobody realized how interconnected everything had become until it was too late. Stage 2. Initial stress. Something triggers the first crack. Not dramatic enough to make headlines, but sophisticated players start pulling back. In September 2008, it was the Reserve Primary Fund breaking the buck after Lehman's collapse. Most people had never heard of money market funds, but $62 billion fled in a single day. Stage 3. The freeze. Suddenly, nobody trusts anyone else. Credit markets seize up. The plumbing stops working. This is exactly where we were in October and November 2025, though most people didn't realize it. Stage 4. Systemic breakdown. The system that everyone took for granted simply stops functioning. The only solution becomes massive central bank intervention or a complete collapse. Let me show you how this exact pattern played out in the most recent crisis most people remember, March 2020. February 2020, everything looked fine. Corporate bond markets were functioning, Treasury markets were liquid, then COVID hit, and suddenly everyone wanted dollars simultaneously. March 9th, 2020, the Treasury market, supposedly the most liquid market in the world, stopped functioning. The 10-year Treasury yield spiked from 0.7% to 1.27% in a single session. Market makers couldn't quote prices. Primary dealers were refusing to intermediate trades. The Fed was forced to announce unlimited QE within 72 hours. But here's what most people don't understand about March 2020. It wasn't really about COVID. COVID was just the trigger. The real problem was that the post-2008 regulatory framework had created a system where banks couldn't provide liquidity when it was needed most. Basel III. Capital requirements meant that precisely when markets needed intermediation, banks were constrained from providing it. Now fast forward to October 2025. Same pattern, different trigger. The system had become even more brittle, even more dependent on a smaller number of critical financial institutions to provide liquidity. And when that liquidity suddenly disappeared, the consequences were immediate and severe. Let me walk you through exactly what happened, using data that most financial media completely ignored. On October 15, 2025, something changed in the Treasury market. Bid-ask spreads on the 10-year Treasury note, which had been averaging 0.4 basis points, suddenly jumped to 2.3 basis points. That might not sound dramatic, but in Treasury markets, that's equivalent to an earthquake. The MOVE index, which measures implied volatility in the bond market, spiked 73% in 5 trading days. But more importantly, the term structure of implied volatility completely inverted. Short-term volatility exceeded long-term volatility by the widest margin since the March 2020 crisis. This is a clear signal that professional traders expect extreme near-term dysfunction. By October 22nd, I started noticing something even more alarming in the corporate bond market. Investment-grade credit spreads widened by 47 basis points in 8 trading sessions. High-yield spreads exploded by 112 basis points. But the really troubling signal was in the ETF market. The largest investment-grade corporate bond ETF, LQD, started trading at a 1.8% discount to its net asset value. This is a clear sign that market makers couldn't efficiently arbitrage between the ETF and underlying bonds. Then came the currency markets. The DXY dollar index surged 4.2% between October 18th and October 31st, but this wasn't normal dollar strength. This was a global scramble for dollar funding. Overnight cross-currency basis swaps turned deeply negative, indicating severe dollar funding stress in European and Asian markets. The 3-month LIBOR OIS spread, a classic indicator of banking system stress, spiked to 34 basis points, levels not seen since early 2023. But here's where it gets really interesting. Despite all this market stress, economic fundamentals were actually improving. Third-quarter GDP growth came in at 2.8% annualized. The unemployment rate remained near historical lows. Consumer spending was resilient. Corporate earnings were beating expectations. This liquidity crisis was completely divorced from economic reality. The Fed's own analysis, which wasn't published until December, revealed the magnitude of the problem. Primary dealer inventories of Treasury securities had fallen to $47 billion, the lowest level since 2007. But more critically, their capacity to warehouse risk had been reduced by post-2008 regulations to the point where they simply couldn't absorb the selling pressure when institutional investors needed liquidity simultaneously. Now here's the part that nobody saw coming, and it reveals something terrifying about how our financial system actually works. The liquidity crisis wasn't caused by banks or traditional financial institutions. It was caused by the Federal Reserve's own quantitative tightening program interacting with structural changes in money market fund regulation that nobody had fully understood. Between 2020 and 2024, the Fed had accumulated $4.7 trillion in Treasury securities on its balance sheet. As they began reducing these holdings through quantitative tightening, they created a massive supply-demand imbalance in the Treasury market. But the problem wasn't just the quantity, it was the timing and the way the market structure had evolved. Money market fund reform implemented in 2023 had created what I can only describe as a liquidity time bomb. The new regulations required prime money market funds to impose fees or gates if weekly liquidity fell below 30% of assets. This created powerful incentives for institutional investors to redeem their holdings at the first sign of stress, which is exactly what happened in October. When the Fed announced additional quantitative tightening at their September meeting, institutional investors began repositioning ahead of expected Treasury supply. But the money market fund regulations meant that as yields began rising, institutional investors pulled $127 billion from prime funds in just 2 weeks. This forced the funds to sell their most liquid holdings, Treasury securities, precisely when the market was already dealing with increased Fed supply. The result was a feedback loop that the Fed's models had never anticipated. Increased Treasury supply led to higher yields, which triggered money market fund redemptions, which forced more Treasury sales, which led to even higher yields and wider bid-ask spreads. Market makers, constrained by post-2008 capital requirements, couldn't step in to provide liquidity. But here's the truly insidious part. This wasn't happening in some obscure corner of the financial system. This was happening in Treasury markets, supposedly the safest, most liquid markets in the world. If you can't trade Treasury securities efficiently, the entire global financial system stops functioning properly. I found evidence of this in the most unlikely place, the Fed's own emergency lending data. The primary credit facility, which hadn't been used since 2010, suddenly saw $23 billion in borrowing during the week of October 28th. Banks were being forced to borrow directly from the Fed because normal interbank markets weren't functioning. More telling was the currency swap line usage. The Fed provides dollar funding to foreign central banks through swap lines, and between October 15th and November 8th, usage spiked to $89 billion. This means that foreign banks and central banks couldn't access dollars through normal market channels and had to rely on emergency Fed facilities. What happened next should serve as a warning for what's coming in 2026, because the Fed's emergency intervention didn't solve the underlying problem. It just temporarily masked it. On November the 1st, Federal Reserve Chair Jerome Powell held an unscheduled press conference. He didn't call it an emergency, but the substance was clear. The Fed was implementing what they called technical adjustments to their balance sheet reduction program. Translation: they were forced to slow quantitative tightening because Treasury markets were breaking down. Within 48 hours, they announced a temporary expansion of the standing repo facility from $500 billion to $750 billion. They extended the Bank Term Funding Program, which was supposed to expire in March 2025, through December 2025. These are not the actions of a central bank that has everything under control. But the most revealing moment came during Powell's press conference when a reporter asked about the relationship between quantitative tightening and Treasury market liquidity. Powell's response was telling: "We are monitoring a range of indicators and will adjust our approach as needed to maintain orderly market conditions." This was Fed speak, for we didn't anticipate this problem, and we're making it up as we go along. The intervention worked, temporarily. By November 15th, Treasury bid-ask spreads had normalized. Credit spreads tightened. The dollar funding stress began to ease. Gold, which had spiked to $4,247 per ounce during the peak stress, retreated to more normal levels. Market participants convinced themselves that the crisis was over. But I found something in the Fed's weekly balance sheet data that suggests this reprieve is temporary. Despite their public statements about slowing quantitative tightening, the Fed's Treasury holdings continued to decline at nearly the same pace through December. The only difference was that they were now providing offsetting liquidity through the standing repo facility, essentially taking money out of the system with one hand while putting it back with the other. This reveals the fundamental problem. The Fed is caught between two impossible objectives. They need to reduce their balance sheet to normalize monetary policy, but the market structure can't handle large-scale Treasury sales without breaking down. They've created what economists call a liquidity trap, but not the kind you read about in textbooks. What I've shown you is not a problem that was solved in November 2025. What I've shown you is a problem that was temporarily papered over with emergency intervention. The underlying structural issues, the interaction between quantitative tightening, money market fund regulation, and bank capital requirements, none of that has changed. In fact, it's gotten worse. The Fed's emergency interventions have created moral hazard. Market participants now know that the Fed will step in whenever Treasury market liquidity deteriorates. This creates incentives for even more aggressive risk-taking and even greater dependence on Fed backstops. Meanwhile, the clock is ticking on several time bombs that will make the October 2025 crisis look minor by comparison. First, the Bank Term Funding Program is scheduled to expire in March 2026, potentially removing $89 billion in emergency liquidity from the banking system. Second, money market fund assets have grown to $6.8 trillion, meaning that any future stress could trigger even larger redemption waves. Third, the Fed still needs to reduce its balance sheet by approximately $3 trillion to return to pre-2020 levels. But perhaps most importantly, The global financial system has become even more dependent on dollar funding since the October crisis. Foreign banks have increased their reliance on short-term dollar funding markets, creating new channels of contagion. Emerging market central banks have reduced their dollar reserves, leaving them more vulnerable to funding stress. Corporate borrowers have issued $847 billion in dollar-denominated debt since November, much of it with floating rate structures tied to short-term funding markets. The pattern I've shown you, hidden vulnerability, initial stress, market freeze, systemic breakdown, this pattern isn't complete. We're still in stage 3. The system appears to be functioning, but only because of extraordinary central bank intervention. The underlying vulnerabilities are larger now than they were in October. I'm not saying the next crisis will happen tomorrow. I'm saying that when it happens, it will be larger and more difficult to contain than anything we've seen before. The Fed's toolbox is already partially deployed. Interest rates are near zero in real terms. The balance sheet is already expanded. The emergency lending facilities are already active. When the next liquidity crisis hits, and the structural problems guarantee that it will hit, the Fed will be forced to choose between financial stability and currency stability. They won't be able to save both simultaneously. That's when the real crisis begins. The signs are already visible for those who know how to read them. Treasury auction bid-to-cover ratios have declined for 6 consecutive auctions. Foreign central bank holdings of Treasury securities have fallen to 15-year lows. Primary dealer Treasury inventories remain near historical minimums. The term structure of repo rates has inverted, indicating expectations of future funding stress. Most telling of all, the Fed's own Financial Stability Report, published in December 2025, contained a previously unheard-of warning about vulnerabilities in short-term funding markets that could amplify shocks to the financial system. This is as close as the Federal Reserve gets to admitting that they don't have the situation under control. So here's my question for you. When the next liquidity crisis hits, when Treasury markets freeze again, when the Fed's emergency interventions prove insufficient, when the choice becomes financial system collapse or currency collapse, which side of that trade do you want to be on? The October 2025 liquidity crisis was the warning. The next one will be the main event. And unlike October, when the Fed could still surprise markets with emergency intervention, next time, everyone will be watching. Next time, everyone will know exactly how fragile this system really is. The music is still playing, but the dance floor is getting smaller, and there are a lot more dancers than there are exits. This is not investment advice. This analysis is based on publicly available data and represents my interpretation of complex financial market dynamics. Past performance does not predict future results.